Hey everyone. One of the top of mind issues for investors right now is the interest rate outlook. Since the beginning of the year, I've been saying that the 10-year Treasury rate would be volatile, hanging in the 4.5% range, but dipping as low as 4% and moving as high as 5%. And so far that's held true. But we're starting to see more forces aligned to the upside risk than the downside. I was talking to a leading economist about a week ago, and that person put the end of year target for the 10-year Treasury rate north of 5%. Now, predicting the 10-year Treasury is often considered a fool's errand. There are so many forces in play, it makes it very difficult to predict. Moody's recent downgrade of US credit is just one more thing that could put upward pressure on Treasury rates. But there are numerous other factors applying upward pressure as well. Broad-based uncertainty, financial market volatility, the movement of foreign capital out of US Treasuries and US dollars, political, trade, and tariff uncertainty, and the fact that we haven't set a 2025 budget yet. In the currently proposed budget, the federal deficit is expected to increase by about $1.9 trillion in 2025, according to the Congressional Budget Office. That would require the issuance of additional treasuries. So far, about $550 billion of treasuries have been issued, so an estimated $1.4 billion will need to be released within the next 5 months, according to the monthly Treasury statement. But that presents a bit of a problem. The pool of buyers for those treasuries may be limited. The Federal Reserve, which holds about $4.2 trillion of treasuries, is still in the process of shrinking their balance sheet, allowing $5 billion of their holdings to burn off each month. So the Fed's buying less treasuries. At the same time, international buyers have been backing off as well. The country holding the most US treasuries, Japan, has been slowly shrinking their treasury balance over the last few years. Their US Treasury balance sheet has fallen from $1.3 trillion in 2021 to about $1.1 trillion currently. China, which was the second largest holder until recently, has been reducing their position since 2013, when it held about $1.3 trillion of US Treasuries. Then in 2022, China began to shrink its purchases more aggressively, and as of the latest data, China's holdings have fallen to about $765 billion. As a result, China was recently supplanted as the second largest international owner of US Treasuries by the United Kingdom, which now holds approximately $779 billion of treasuries as of April. Another major risk exerting upward pressure on the 10-year rate is tied to the US budget. According to the Yale Budget Lab, the current reconciliation bill is projected to add another $5 trillion to the deficit over the next decade. Even when accounting for possible revenues from the tariffs, the budget's still projected to add $2.5 trillion to the deficit over the next 10 years. And of course, increasing the budget deficit requires increased Treasury issuance. The other major lever that could potentially move interest rates is what the Fed does with the overnight rate. Currently, the Fed funds rate is 4.25%, where it's been since December last year. If you look at FedWatch, which basically tracks Wall Street activity to predict the likelihood of future rate cuts, they're still predicting that the Federal Reserve will lower rates at some point this year. FedWatch is assigning a 75% probability that the Federal Reserve will reduce the overnight rate by at least 50 basis points by the end of the year. However, based on what the Fed Chairman Jerome Powell has been saying, I'm not so sure that we'll see any cuts from the Fed this year. I think the Federal Reserve is much more concerned about trade policy-driven inflation risk than they are about recession risk, at least for now. And even if the Fed were to reduce rates, there's not a one-to-one relationship between the overnight rate and the longer-term rates like the 10-year Treasury, most often used for commercial real estate lending. So my takeaway here is that while it's possible rates could come down, investors probably need to plan for higher interest rates this year. For buyers working on a deal today, that means there's a greater probability rates will go up than down, and if you agree with that, you probably want to lock your loan sooner rather than later. For sellers, if we go into another round of rising interest rates, there's a good chance that cap rates could chase them up, eroding property prices. Again, for sellers, it's probably better to act sooner rather than later. But by the same token, buyers probably shouldn't move to the sidelines and wait for prices to fall. Again, the correlation between interest rates and cap rates is not a 1-for-1 ratio, and sitting on the sidelines doesn't generate a return. At the end of the day, there are still a lot of properties available that offer positive leverage or have a pathway to positive returns on debt over a relatively short time span if value is added to the property. And that's probably going to be the key this year, creating value by improving the property through upgrades, through better management, through leasing decisions and tenant mix, and so on. So while interest rates may face upward pressure this year, investors need to consider the operating climate and where the market will go over the hold period, 3 years, 5 years, 7 years, or longer. And that's why investors always need to keep their eyes on the horizon.